Information shared on the following program is for general information purposes only. It does not constitute legal, tax, investment, or other advice, nor is it intended to recommend any particular investments, products, or financial instruments. Always seek advice from your financial advisor, attorney, or accountant with regard to investment, legal, or tax questions.
So you can buy all the pantyhose you want, but I can't even buy one stinking annuity?
What about that iron lung you bought? It just cured polio, you idiot. You always fall for these scam artists.
This guy says he can get me an 8% return, honey. 8%? Don't you want to retire worry-free?
You know what? Fine. Buy it with this.
What does she know?
Welcome to the only show in the country dedicated to helping savers worry less about money, the Worry-Free Retirement, with your host, nationally recognized retirement specialist and six-time author and fiduciary, Tony Walker.
Welcome, folks, to the Worry-Free Retirement. And yes, I am that little man in the sweater vest, Tony Walker. And for our second week in a row, we have our brand new format here. That's right, folks. After more than 515 episodes of what we call the Walter Cronkite style of filming, we're trying to experiment a little bit with more of a podcast format and also introduce more and more staff into the show and introduce more of our videos that we've done in the past that are just excellent in terms of tying in this content for savers. So nothing changes about the content. We just hope that we're going to bring you even more of it. Now, speaking of content and what's happened over the years with annuities, today we're going to focus on the increasing popularity of annuities. That's right, folks. Believe it or not, these products that have been trashed for years, some products we've used very successfully long before most people even talked about annuities, all of a sudden, as we record this show in May of 2024, they're coming in with a vengeance, and of all people selling them is the folks on Wall Street. And to help introduce this subject and talk more about why these annuities are getting so popular, come on in, my favorite son-in-law fellow fiduciary, Mr. Trey Juergens. Good morning, Trey.
Good morning. Thank you for having me.
Well, thanks again, and I hope, are you enjoying the new format?
I like it, yeah. You get to just kind of yak about all the stuff going on in the industry. It's fun.
Well, good deal. And we appreciate Aaron and Derek so much. They're continually producing the show. We've had to make a lot of adjustments, but I think in the long run, it's going to allow us to just kind of share with all the viewers out there the number of staff we have and the expertise we have in this area. So if you could, we go back in, and I hearken to the day back in 2001 when I sold the first fixed indexed annuity, became pretty prevalent in selling a lot of those, took a lot of heat back in that time. But kind of tell folks what's happening now with the popularity of annuities.
Well, they're exploding. That's 2023, according to LIMRA, was the absolute record year for annuity sales. And we're up 21% over the same period in Q1 of 2024. So the huge boom in sales, more particularly a huge boom in independent advisors using these products.
And I think we've got a nice clip coming up here, one that deals with the pros and cons of annuity. You want to kind of set the stage there?
Yes, this is actually a YouTube clip pulled from a previous show. But the beauty is we get to meet with a lot of our clients. And when they say, that clip on YouTube, that was really an aha moment. It's the pros and cons of annuities. And it just gets into the good, bad, and the ugly, but also why we like these products and savers should too.
All right, well, let's let her roll, Derek.
What we're going to do, because again, as I say, I've done this 35 years, folks. Here's what bothers me. One thing that bothers me, if you want to get under my dandruff, is people on radio, TV, the internet, people who think they know it all. I'll call them financial know-it-alls. So here's the key. Whenever you hear anybody, even if I slip up and do this, I call them the never say never crowd. If I tell you never to do this or never to do that or always do this, turn off the TV, turn off the radio. Folks, a retirement planning specialist, and I've understood this over the year, there is no one size fits all. Certain products are good for certain situations, sometimes they're not. The reason we always talk about annuities on this program is because we're working for savers. We don't work with investors and speculators. Most investors and speculators, quite frankly, are not that crazy about annuities, and I can understand why. Because annuities are not set to grow a lot. They're not meant for that. They're meant for principal protection and they're meant so that you won't run out of money. That's the purpose of an annuity. If you use it for anything other than that, you're probably not going to be satisfied. So let's look at the pros and the cons. Let's start with the pros, okay? By the way, Benjamin Franklin was known to do this. This is kind of fun. Just lay out sometimes if you're thinking about something. Start with the pros. That's what the things that would be helpful, and the cons, the things that may not. So the first pro we have with annuity, we've talked about this, is principal protection. The idea of going into retirement, nearing retirement, being retired, and knowing that your principal is protected, you're not going to lose anything, to me that's a huge advantage. The second pro is whatever you make is never lost. Remember over here, we have a floor. Whatever you make, if the market goes down, you don't lose anything. That's a wonderful thing, folks. Pro number 3, I love this one. It's a contract. I love contracts. Why would you want an investment that somebody could finagle all the time? I want a contract. I don't want it to change. Now, the problem is people say, well, annuities are complicated. They're contracts. Well, take time to read the contract. It ain't that complicated. But yeah, you can't be lazy. You've got to study these contracts so you can understand how to utilize them. Minimum amount size. Folks, a lot of people think that you got to have $500,000 to work with Tony Walker Financial. We can open up an account for you, depending on your other assets. I have to put a caveat there. For $5,000, you can start an annuity. That's not that much money, okay? Again, there's a caveat. We'd have to talk about that, but you can open them for as low as $5,000. I like this, avoids probate. You know, many of you are going out and you're worried about living trusts and spending all this money on documents. Did you realize if you have an annuity, it avoids probate? That's because it passes by beneficiary. Great situation there to avoid probate. Tax deferred. This can have pros and cons. We'll see this in a minute, but in theory, it's great. Let's say right now you've got a CD and it's paying some interest, or a bond that's taxable and you're not using the money. Well, folks, that's creating a huge opportunity cost because you're paying taxes on the same dollar over and over. With an annuity, because it's tax deferred, you defer those taxes, which saves what we call opportunity costs. Next, we have flexibility. The reason people think that annuity is tied up is because they don't understand how to make it flexible, okay? You've got to understand, you don't put 100% of your money in annuities. Annuities are a piece of the puzzle, but they're not the whole puzzle. I love this. Unless it's a variable annuities, majority of annuities we offer have no fees or very, very low fees. So we don't have to worry about that. And finally, I like the asset-backed protection of the insurance company, the claims paying ability of that big company, the state guarantee funds that offer certain limits. That's a wonderful thing. Another pro, a lot of people don't understand this. If there is anything left in the annuity, let's say you had $100,000 and you start drawing income and die in the third year, with most annuities, again, depending on how it's set up, whatever's left in the annuity immediately goes to your beneficiaries. Even if you had your wife as a beneficiary and you forgot to change it, maybe she had passed away or he had passed away, then the children would still get it. So this idea, folks, that most annuities are gone when you die, again, it all depends. This is where we can help educate you about the proper use of annuities and what happens when you die. Finally, the cons. Folks, we're going to get into this in another show. We've got to talk about tax issues. Actually, annuities sometimes can create tax problems. You got to watch that. Potentially high fees. Like I said, we don't do variable annuities because we don't want to be paying out the nose and all these fees. They can be complicated. I get it. Most people that come to us, a lot of people have already had annuities, and the problem was either the person that sold them the annuity didn't understand it, or there's no written game plan accompanying the annuity, so the whole thing seems like a complicated mess. Again, that can usually be avoided. Low rates of return. Look, folks, annuities are not meant to make you 8, 9, 10%. Occasionally they might do that. We've had them do that in the past with a fixed indexed annuity. That's not what we're trying to do. We're trying to protect principal, earn a reasonable rate of return, and not run out of money. Don't forget the purpose of annuity. Surrender charges. Yep. That's why you better have a plan that sets in motion a way to avoid these surrender charges. Most annuities have surrender charges, and if you cancel that thing at the wrong time, it can be a doozy. So again, one more reason you should be working with a trained retirement specialist that understands annuities.
And now it's time for Tony in the Trenches.
Hey everyone, thanks for joining us here on the Worry-Free Retirement. I've got our next Tony in the Trenches right here, so let's get to it. This TNT comes to us from Scott in Louisville. Tony, I've recently inherited some accounts from my father's estate. His advisor was a stockbroker type, and he was with him for years. Over time, it's done quite well, but I'm not sure I've got the stomach to have all of this money in the stock market. Can I invest my money in safer territory with you and not trigger taxes on this money?
Very interesting question. And with so many people now having so much money and starting to pass away, we're seeing more and more baby boomers, adult children who are starting to receive, in some cases, very, very substantial inheritances. In fact, in 2023, we had 55 of our own clients die, and I'm in most of these meetings. I'm meeting with adult children to try to figure out, number one, what are they going to receive, and number two, more importantly sometimes, what are the tax ramifications of the money we're about to receive. Now, in Scott's case here, let's walk over to the whiteboard because I want to make a distinction and imagine we're receiving two different types of assets so Scott will understand what's taxable, what's not, and if it is taxable, how much money is he going to have to pay in taxes on this inheritance? So in our example, and again, we're running into this more and more, folks, we have adult children constantly coming to us after their parents, our clients, are passing away. And I see things like this all the time. We're going to use round numbers so I can keep this very basic. But again, there was an inheritance received by this son from the death of his father of $600,000. And what we're going to assume of that $600,000, 300 was what's called, we'll abbreviate it, non-qualified. And we'll just say this was a basket of stocks that his father had owned at the time of his death worth $300,000. The father also left to the son, whenever you see the word qualified, that means qualified for tax treatment. That's right, this was a tax-infested IRA. So remember, folks, these IRAs are wonderful. 401ks are wonderful savings tools. The problem at death, your heirs are more than likely going to have pay a boatload in taxes on them. And I'll show you the advantages of leaving something as to what we call non-qualified for tax purposes at death versus qualified. All right, so there's a key term that's used called your cost basis, okay? And let's say this father, over time, had invested $100,000 in this basket of stocks. That would be his cost basis. So the father during his lifetime said, nah, I don't want these stocks anymore. I'm just going to sell them. Well, obviously, there's a gain of $200,000 there. If the father would have sold these stocks during his lifetime, he would have had to pay capital gains on $200,000 of gains, all right? Let's keep going. And let's say his cost basis of the IRA was $100,000 as well. Same thing. It's a little different, though. If he had sold and liquidated the entire IRA during his lifetime, he does not get to deduct the cost basis. In other words, the full $300,000 would be fully taxable, and not at capital gains rates, which are much lower, but at ordinary income tax rates, which again, we'll do some calculations in a minute, some big numbers here. So let's go back to this. This is important because at death, it's called a step up. So since the father held on to these stocks and it was a non-qualified account, the son got the full $300,000 with no taxes, okay? This applies to real estate and a lot of things. Huge advantage there. But what happened over here on the $300,000 IRA? There was no step up in basis. Let me grab this blue pen here. They would take the $300,000, and let's say the son was making a good income right now. Maybe he's a physician or a high-paid executive somewhere, and let's say he was in a 40% tax bracket. He's going to owe the IRS $120,000 in taxes. Now you say, well, couldn't he stretch that out? Well, you used to be able to stretch it out over your lifetime, but not anymore. If you're a non-spouse, you have to pay that out within 10 years, and this is a huge dilemma. They understand when they recently changed the law to make all these beneficiaries take this money within 10 years, all this tax revenue is going to flow in. So you might be sitting there saying right now, you might be saying, well, Tony, I'm getting to this age now. I haven't thought about how things are going to be taxed when we die. You need to understand that taxation affects assets differently. This is why at Tony Walker Financial, when you meet with me, we're going to go through a full analysis of tax planning, investment planning. We're going to look at the whole ball of wax, annuities, look at all of that and put that into our proprietary game plan. So if that's you right now, if you don't have a game plan, if you don't feel like you've got an advisor that's doing what we call holistic planning, why don't you do this right now? Log on to TonyWalkerFinancial.com. That's TonyWalkerFinancial.com. Click on that Let's Get Started, or give us a call 24/7 at 877-499-5555.
9255.
Our client spotlight today shines brightly on Mr. Greg Ray. Greg, good afternoon, and thanks for joining us today.
Nice to be here, Tony. Thanks for having me.
You're so welcome. So what prompted you to contact us at this time? Because you've only been a client, about a year or so. So what prompted you to contact us?
I just happened on Sunday morning to see the Tony Walker Show, quite frankly, Tony. Yeah. And from there, I'd say a year and a half ago, we really could relate to your story. We bought your book, Live Well, Die Broke, or whatever it is. Yep. And your story and your principles and your Christian foundation and thoughts about and the balance of, what do you need to have? What do you want to leave to your kids or what have you? Because I got a couple of boys and their families, and then, the rest of it, how you want to live your life while you still can live your life, that is. So those three things align with the values and all that. We stopped in for a visit. We simply came in and asked for a visit, and we got to sit down with you, and that was about a year and a half ago, and we're so glad we did. So,
and again, not to disparage anybody, but going from a large bank to I'd say we're more of a boutique firm, locally owned and everything, service-wise and everything, what have you experienced maybe that's a little different?
Well, the biggest thing is, and probably the most surprising thing is, the presentation of the suite of products that you had. If we wanted to stay in the stock market and play the stock market game, which is a little bit more risky, you had the Charles Schwab product suite, fine and dandy. We could continue doing what we've been doing basically through the bank. The fixed income annuity package, some of the things that you had in long-term care planning, the tax planning, the retirement planning, and working, making a plan and working the plan, and the responsiveness of all of your staff is just incredible. That personal relationship. I mean, you guys, it's so responsive to what we wanted. There was no big business or a changeover who your assigned investment banker was week over week or month over month as people moved in and out the branch offices and different things. So very pleased with the individual service.
Well, we appreciate your business and hopefully many more years to come. So thank you, Greg, for doing business with Tony Walker Financial.
And Tony, best to you. We appreciate all you've done for us.
You're welcome.
Looking to roll over your 401k? Then log on to TonyWalkerFinancial.com and learn just how easy it is to roll over and safeguard your 401k. Do it today.
So this guy thinks we should enjoy our money instead of never spending it. He calls it the live well, die broke philosophy.
Is this the little man in the sweater vest on TV?
Yeah, that's him. Though he goes by Tony Walker.
Oh, Frank, that man only works with millionaire Rockefeller types.
Now, that's not true. He works with everyday, hard-working Americans just like us.
So does that mean I can afford more pantyhose?
Oh, I'm sorry, honey. I already donated the rest to Jimmy Hoffa.
Welcome back to the Worry-Free Retirement. I am Tony Walker along with fellow fiduciary Mr. Trey Juergens, and I hold in my hand, this article just blew me away, where BlackRock, a huge Wall Street firm, because their target date funds cannot guarantee lifetime income, Trey, something we've known for years, they're now creating a 401k, as it says, with a monthly check. What is BlackRock all of a sudden introducing to Joe Saber?
Pension.
A pension.
Mailbox money.
Mailbox money. Annuities, whatever you want to call it, folks. This is just comical. And I love this. I've always said that the reason Wall Street will not sell annuities up until now is they haven't been able to figure out how to charge for them. You see, folks, most people who sell annuities, like us, get a commission. And Wall Street doesn't like commissions. They rather have recurring fees on your money. It says there are fees in the spread of the annuity that you cannot see. So I think this is real interesting, Trey. So what would you share with our listening audience out there before they just rush into an annuity with maybe even somebody on Wall Street that all of a sudden is excited about them in terms of having that written game plan before buying the annuity?
Yeah, well, this mailbox money is great. Without a plan, there really is no good use for these types of annuities. However, this next clip that you go to the whiteboard on, it talks about how private pensions are possible through private annuities. So this clip will tee it up.
More and more companies are starting to think about going back and offering pensions, something that hasn't been done in years. In fact, IBM is no longer going to contribute to the 401k, but set up pensions for their employees. The problem is, if you're retired or nearing retirement, these don't help you. What we're going to do at Tony Walker Financial is show you how we can take existing assets and create that mailbox money so you can establish your own personal private pension plan. And here's how this would work. You basically have two options, okay? This is called an immediate annuity. And again, folks, if you want a private pension plan with mailbox money, remember, only annuities can provide this. No other asset can guarantee an income for the rest of your life or a set period of time. So you could do an immediate annuity. It's really interesting. A gentleman just came in to see me this morning before we recorded the show. This article, he said, "Hey, Tony, what's this deal here where I can put $300,000 into a single premium immediate annuity? What's that all about?" Well, that's what we're talking about. This would be a private pension that would be paid for your life, for a period certain, or you could have a survivor option, but you cannot change this, okay? And in most cases, at death, there's zero left. So this would be an example. This particular gentleman was single. He's in his late 70s. He has a long life expectancy. He just wants principal and interest, but he wants it guaranteed for the rest of his life. He is actually a pretty good candidate for an immediate annuity. But what if you might want to change your mind down the road, or you're not sure when you want to start the income? That's called a deferred annuity. Deferred annuity. And these are relatively new. They're called income riders. Now, a deferred annuity with an income rider is a little different. It's for you and your spouse, okay? Those are the only two parties that can receive this guaranteed income for life. Now, the advantage, you can start it whenever you want, but once you start it, you could also stop the income, and whatever principal is left in there, if any, okay, could go to you. You could decide to take the principal back out, stop the income payment, or you could leave it to beneficiaries at your death. So this one actually is much more flexible, but in certain cases, you may want to consider the immediate annuity. So the only way to know which annuity is going to be right for you is dealing with a trained retirement specialist such as Tony Walker Financial. Folks, I've written over 3,000 annuities totaling over $600 million over the last 20 years. I know these products very well, and the worst thing you can do is get stuck in the wrong annuity. So if you're looking to safeguard more of your money, if you're wanting to develop that personal private pension plan that we offer at Tony Walker Financial, do this. Log on to TonyWalkerFinancial.com. That's TonyWalkerFinancial.com. We'd be happy to talk to you about your specific situation. Have you ever wondered what truly makes retirement worry-free? Well, as someone who has worked for years in the field of retirement planning, I can tell you this. Being worry-free in retirement is not just how much money you've saved for retirement, it's how you are planning on using and enjoying this money without the fear of one day running out. And that's the beauty of what we call mailbox money. It's a steady stream of income, reliable lifetime income, just like the pension my granddad once enjoyed. Hi, my name is Tony Walker, and if you're looking to turn your 401k or other retirement assets into a guaranteed stream of monthly income you can never outlive, let's talk. To set up a quick phone call with me is easy, and best of all, it's free. We call it the free 10-minute fiduciary phone call. To get started, log on to TonyWalkerFinancial.com. That's TonyWalkerFinancial.com, or call us at 877-499-9255. Have you recently retired, been laid off, or offered a pension buyout? Has the company you work for moved, been acquired, or closed its doors forever? And finally, do you have a 401k with a previous employer you'd like to move to safer territory? Then take advantage of this opportunity to move your 401k or lump sum pension to Tony Walker Financial. Let's meet in person to discuss your retirement options. Log on now to TonyWalkerFinancial.com to schedule your free, no-obligation appointment. Let us help you today. Did you realize that if you have more than $250,000 in retirement assets, the government could tax as much as 40% of it when you go to take it out? And with current tax rates set to expire in 2025, the taxes you will owe on your 401k could climb even higher. Don't wait until 2025 to see how much Uncle Sam will take of your money. Get a game plan by logging on to TonyWalkerFinancial.com. That's TonyWalkerFinancial.com.
And Tony, back to this LIMRA article about just the absolute booming growth of annuities. Let's break down some of these numbers here. So in 2023, total annuity sales reached $289 billion with a B. And in fixed rate deferred annuity sales, that was a huge growth, reaching $113 billion annually. One of the biggest things I think that's interesting to take away, just so far, like I said before, Q1 2024, sales hit almost $114 billion, the highest in history, up 21% from this same period last year, which was the absolute record year.
And I guess what makes me a little nervous, Trey, is go back to that statistic. What percentage are independents? Well, we're an independent, of course, but let's kind of think of what is an independent and why are independents selling so many of these annuities, you think?
Yeah, they didn't share an exact number in terms of growth, but they said independent distribution channels experienced extraordinary growth, contributing to this overall increase in annuity sales. That's, like I said earlier, good and bad thing. It's access to these great products for savers. However, there's a lot of dinner seminars. There's a lot of people down the hall at the bank that get licensed to sell these products, and they don't know how to work them into a game plan.
Yeah, let me remind you, folks, if you're considering an annuity, all it takes, now technically this is not accurate, what I'm getting ready to say. We're going to get into the regulations of annuities in a minute, but all it really takes to be able to sell an annuity is an insurance license. Now think about this, folks. What does it take, about 6 weeks to get a license? 6 to 8 weeks?
Yes, okay.
So I could take Anthony, who knows nothing about annuities. He could pass a test in 6 to 8 weeks. He's on the street selling annuities. Pretty scary stuff, isn't it? That's a real scary thing about Anthony selling annuities. But anyway, so I guess my concern is if all of these independents are now selling annuities, if savers are realizing maybe I do need an annuity, people are going to rush out, buy an annuity, and as we like to say, get stuck in the wrong annuity. So how often, Trey, because you see a lot of people with me in Louisville, our office especially, do we see somebody come into our office who wants a second opinion? They've bought an annuity, and we have to tell them you're probably stuck in that annuity.
No, it's a daily occurrence, and we get the phone calls. We've got this annuity. I know you all love annuities. Can you help me with this? Well, where's your agent?
Yeah, folks, that's the thing. We really can't help if you've just bought the annuity. So that's why we always say, if you're thinking about buying an annuity before you buy it, at least get a second opinion. And we do have a great download on this. If you're going to go to TonyWalkerFinancial.com, just click on the download section. It's called Annuities Made Easy. Trey, everybody that's read that book that comes into us say, finally, I can at least understand these products.
Now, it was written for savers. I know one of the biggest knocks, and when we talk about the pros and cons of annuities, is how complex they can be. But when you break it down and really slow down and try to understand these products, they're contracts with insurance companies that provide you some guarantee, something that Wall Street can't guarantee.
And then the final thing we'd like to say, a lot of the growth of these annuities is in what we call fixed annuities. So again, folks, there's two primary types of fixed annuities. There's fixed interest and fixed indexed. And as we record this show in May of 2024, some people are shocked that we can get right now, all the way up to 10 years length of time, Trey, 5% guaranteed rates of return with no fees for up to 10 years.
Oh, it's pretty awesome.
I mean, yeah, you take somebody that's 65 and you put $200,000 in and you get $10,000 a year guaranteed for 10 years. You could take it out, let it compound, and at the end of 10 years, you still got your $200,000. I mean, that's a heck of a deal for a saver.
No, it's a pretty sweet deal, especially when you look at Wall Street saying to live by that 4% model. Well, if you can get 5% with no fees, that's doing something.
So, folks, I hope you've enjoyed today's program on annuities. Here's what I would say. If you're retiring soon, then why don't you do this? Why don't you log on to TonyWalkerFinancial.com. That's TonyWalkerFinancial.com. Click on that Let's Get Started button. Let's set up that free fiduciary phone call. There's no cost or obligation. And if the Internet's not your thing, you just want to give us a call 24/7. Our phone number, 877-499-9255. That's 877-499-WALK. Well, that's all the time we have today. But you remember, between now and next week, if all else fails, you be worry-free and make it a good day.